Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela Tran here, and today we are going to work on some IFM practice problems. This section is 5-2, the advanced level. Problem 1. You are given the following information about firm A. The debt to value ratio is 0.7. Equity beta is 1.45. Debt beta is 0.35. A project requires an initial investment of $7,500. Estimate the minimum net present value required so that the firm is happy to issue new equity to undertake this project. Alright, so for this problem we have the debt to value ratio 0.7. We got the beta of the equity and beta of debt, and we got projects require initial investment of $7,500. So in order to benefit from this projects, we require NPV has to be at least the investment amount times with the ratio of beta D times D over beta E times E. The investment amount here is $7,500. Beta D is 0.35, beta E is 1.45. These are given. And for the debt to value ratio, D over E here is 7/3 because the debt to value ratio is 0.7, which means debt amount is 70% of the value and equity is 30%, which means debt over equity is 7/3. So the minimum net present value required is 4224.14. Problem 2. Assume that the proposition hold. You are given the following information about firm: equity beta, debt to equity ratio. The firm plans to increase its debt to equity ratio to 2.5, and such change it will double the debt beta. Determine the equity beta after the increase in leverage. So before the increase in leverage, let's consider the capital structure of this firm. We got equity beta is 0.9, debt beta is 0.1, debt to equity ratio is 0.25, which means debt over E is 0.25. So the debt to value is 0.2 and the equity to value is 0.8. And we calculate the beta of the firm by using the weighted mean. So we got 0.2, which is the debt to value ratio times with beta of debt, plus 0.8 is a ratio of equity to value times beta of E. We got 0.75. That is the beta for the firm before the increase in leverage. Now after the increase in leverage, the debt to equity ratio changed to 0.5, which means D over E is 0.5. So the debt ratio to value is 1/3 and the equity value to equity ratio to value is 2/3. So we of course we have these two have identical assets. So the beta before and after the plane should be the same. So we got 0.74 is equal to beta, but now the capital structure had changed to 1/3 debt and 2/3 equity. So we got 1/3 times with 0.2, which is beta of debt, plus 2/3 times beta of equity. Because beta of debt here has been doubled from 0.1 to 0.2. That's why we got 0.2 here. So we got a new equation of beta E, and we got beta E is 1.01, which means the equity beta after the increase in leverage is 1.01. Problem 3. A firm is financed with both equity and debt. The firm assets are expected to generate an income before tax and interest of $3,500 this year. You're given the market value of debt is $90,000. The debt interest is 2.5%. Corporate tax rate is 35%. Determine the total net income available to all investors. All investors here, if you look at this company, they have debt and they also have equity. So there should be two types of holder, two types of investors: the debt holder and the equity holder. And we need to find the net income for each of them and then combine them for the total net income available to investors. So now we see we have equity holder and debt holder. The market value of debt is $90,000 with debt interest 2.5% and tax is added 35%. And the income before tax and interest is $3,500. So let's say if we consider the equity holder, then the earning before tax and interest $3,500. So the net income should be the earning before tax and interest, subtract interest and subtract tax. So the net income for equity holder is $3,500 subtract debt interest, which is 90,000 times 0.025, then time with 1 subtract 0.35 because we have to pay 35% for taxes. So the net income for equity holder is $12.5. And for debt holder, we got 90,000 debt with debt interest is 2.5%. So the debt holder would have the net income, which is 90,000 times 0.025, which is $22.50. So here we see in this firm, the equity holder net income is $12.5 and the debt holder net income is $2,250. So the total net income for all the investors available here is just the sum of them, which is $12.5 plus 812.5 plus 22.50, and it is equal to 32.5. Problem 4, a firm will be worth either 8,000 or 30,000 with equal probabilities in 1 year. The firm has the following capital structure: equity, stocks 1,000 outstanding share, debt, bonds face value is 10,000 due in 1 year. You're also given the following information: the present value of the financial distress cost is calculated, the debt cost of capital, determine the firm market value. Here, if you look at the second table, we have equity cost of capital is 6%, and the debt cost of capital is 30%. Bankruptcy cost is 2,000. So we see there are two cases here, two possibilities here. Either the case of bankruptcy and the case of successful business. So if we consider bankruptcy case, the firm will worth only $8,000 in case of bankruptcy, but debt is 10,000. Hold up. We need to pay one more attention to all of these numbers: 8,000, 30,000, and 10,000. All of these are the number in 1 year. So we are actually considering the time frame at 1 year later at t equal to 1. Alright, so in case of bankruptcy, a year later, the firm is worth 8,000, but debt is 10,000. So basically, the equity holder not gonna have any money, and this 8,000 had to be paid to the debt holder. So the debt value should be 8,000, and the equity is 0. However, we also have to pay for bankruptcy costs, which is 2,000. So the debt holder would earn only 6,000, and the equity holder would take nothing. That is in case of bankruptcy. Now, in case of successful business, we got 30,000 is the firm value, and debt is 10,000, so equity holder would receive 20,000 and debt holder would receive 10,000. And of course we don't have to pay the bankruptcy cost of 2,000 because this is not a bankruptcy case. So basically, in case of bankruptcy, debt holder receives 6,000, shareholder receives $0. Otherwise, debt holder receives 10,000, shareholder receives 20,000. So in a year, the average of debt, the expected value of debt should be the average of the two cases because they have equal probabilities. So debt value should be 6,000 plus 10,000 divided by 2, which is 8,000. And equity value should be 10,000. And these number 8,000 and 10,000 are calculated at 1 year later. So in order to find the firm market value at this present moment, we have to bring these two numbers back to time 0. Here the equity cost of capital is 6%, so we take equity 10,000 divided by 1.06 to bring the money from time 1 to time 0. And the debt value is 8,000 at time 1, with the debt cost of capital is 3%. So we have to bring this 8,000 to time 0 by divided by 1.03 and add them together. We got the firm market value is 17,200.95. So that is how we calculate the firm market value. The firm market value means the present value of the firm. Problem 5. Acme Inc. had 30 million shares outstanding. The share price of Acme is 40. It also has 800 million of outstanding debt. The board of directors of Acme has decided to unlever the firm by issuing new equity and retiring half of the outstanding debt. Assume perfect capital markets. You hold 510 shares of Acme and you disagree with the decision to unlever the firm. How can you undo the effect of this decision? So let's consider before unlever and after unlever. Before restructure, before the unleverage, we got the equity value is 30 million times 40 because we have 30 million share outstanding with a share price of 40, so it should be 1,200 millions. And the debt here is 800 million. But after restructure, the board of directors want to retire in half of the outstanding debt, which means the debt should be 400. And remember that the value of the firm should be the same, so we should have 400 million added to equity. So equity now is 1,600 and debt is 400 to make sure the total remain the same. And here you have 510 shares of Acme, which means that the amount that you invested, V here, is 510 times the share price 40, and you got $20,400 invested. Now, in order to undo the effects of this decision, you need to buy, which means from the structure of the after structure, you want to go back to the before restructure. So you need to buy E over E star times V, which is 1,600 over 1,200 times 2,400. V here is the amount of money you invested, means the investment amount. E is the current equity amount. E star is the desired equity amount. So we got 27,200. This is the amount of equity that you need to buy. But you have only 20,400 and you want to buy 27,200, which means you need to borrow more money to fill in the gap. So you would need to borrow the gap, which is 6,800, to buy 170 more shares. Alright, so that's it for today. Thanks so much for watching. I hope you like this video. Please like, share, and subscribe if you are interested.